Kerry, I
Yeah.
wanted to share this chart, not to be a buzzkill, but I wouldn't feel good about myself if I didn't share this today. This is a chart and talk about returns. If you could bet on this, this is the overnight repurchase agreement. Um, this is where banks, countries, um, confirm or hedge funds or institutions go to the Federal Reserve window overnight and exchange securities, mortgage-backed securities or treasuries in exchange for cash. Okay, it's for short-term loans, that kind of thing. And so, this I've been watching this over the last week or so, but you can see these little spikes. Typically, it's been basically at zero for a long time. Well, tonight it jumped to 50 billion. So 50 there's a so what has happened is, so for instance, this was on the September 30th. Banks or institutions came to the window, exchanged assets. In most cases, it's CMOs, collateralized mortgage obligations.
Mm-hmm.
They exchanged for 60 billion in cash. Then again, 8.35 billion on October 16th. And you're down around 3 or so billion. Then had a spike again on the 27th of October of 8.4. On the Wednesday, it was 10.31, and today it's 50.35 billion. If I go back and I look for when the last time it happened like this, it was June 11th, 2020,
That was around pandemic time.
pandemic time. This is weird.
That is,
This is
I agree.
this is if I and I went on Grok and I said, what does this mean? And this is what he came back and said. In broader context, the Fed's October 29th, 30 through the 30th, 2025 policy meeting, where they cut rates by 25 basis points and announced plans to halt QT, quantitative tightening, on Treasury holdings starting December 1st. This repo spike reinforces the signal that reserves are getting scarce, potentially influencing future monetary policy decisions to prioritize liquidity support over further balance sheet reduction. While not a full-blown crisis, it's a yellow flag for market participants, as persistent usage could lead to volatility in interest rates or even prompt additional Fed intervention.
So
It's been at zero.
let
It's
me
been
just
at zero.
let me just play this back so that I have some understanding of it. This is a movement of money from the Fed to banks.
No, this is a
No.
movement of my region's bank saying we don't have enough cash to meet our overnight obligations. They take their CMOs to the
What's a
window or
CMO? What's a CMO?
collateralized mortgage obligations. It's where
Or
you
their
package
treasuries.
up, or treasuries, you package up all these mortgages into a bond and you sell it to the retail investor.
I still
um,
don't understand what that's movement
so
of
they
money.
take that asset
You're
and they
saying
go to
the bank doesn't have enough to meet its obligations, so it's coming to the Fed and asking for money, and this is a measurement of the size of the ask.
yes.
Okay. Now this number, the spike that you go back to, as I saw it, no, the one in July.
June,
I think it was the end of the month, right?
June 27th.
Okay. June 27th. Okay, that's not the end of the month. I'm just wondering if it has something to do it's the 31st of October. Not that it's
Well,
no, but now I see here, it has more to do. Okay, so why is the bank doesn't have needs money, and is that because businesses are coming and trying to borrow?
it's probably no. This is more, if you look at this, it's been at zero
I know,
since
but I'm
June.
trying to
It's
understand why, if I'm Regions Bank, why did I go ask for $100 million?
because 110 went out the door.
In the form of loans?
Form of
Or
people would
delinquencies,
What? What?
or delinquencies. Their loans are going bad, or they're late.
So what, this could be end of month, we're balancing our books and we're in
this
balance because of the delinquency we had in the preceding 30 days?
has
It
been
doesn't have
so
anything to
high.
do with end of month.
Huh?
This is just, we need it now, and we've been seeing this activity
Yeah.
for the last, well, since June 19th, these big spikes.
Well, again, what I'm trying to determine, is it because business is good or business is bad? You're assuming
Business is
it's
bad.
because you're assuming it's because business is bad. But if I need
Okay,
that much money, it could
let me
be.
ask you,
Would you give me the possibility that it could be good?
no, I can't. Has business been good since June of 2020?
Yeah, well, yeah, that was the end of the pandemic ended in basic.
And has the economy, has the stock market gone up since 2020?
Yeah,
Okay. So no
except
borrowing,
for a couple months.
no need until July of this year, and then here recently.
Okay,
You following me?
I understand there is a need, but I don't
There's a
know
need for
why.
liquidity.
For
Folks,
liquidity.
can you hear me, folks? This is Gerhard.
Yeah.
Okay,
Maybe I can help on the issue. Hi, this is the first time I'm taking part in this conversation. This is a repo facility. Usually, this is the steering of short-term liquidity, which is provided by the Fed to the commercial banks. And very often, not to the extent that I see on this chart, but most of the times, liquidity becomes a little bit thinner versus month end, quarter end, year end. And this is usually, the case when commercial banks take collateral. That could be, usually it's treasuries, it's CMOs, CLOs, anything of good quality that they postpone with the Fed and in return get liquidity. Usually we have weekend and we have month end. So we're going to be talking about over weekend liquidity that banks need at month end to fulfill, their liquidity requirements until Monday. Now, looking at this chart, which I do not know, it's the first time I see it, and I find it very interesting, Trent. It indicates that liquidity is very, very short. That's for sure, because it's an exaggeration as seen on the chart. What we're going to have to wait for in this case is for some news to emerge over the weekend or maybe Monday, or which is, if it's a normal, liquidity need and requirement, this thing should just disappear and evaporate on Monday, Tuesday. So this is just a little bit on the background on this, if it
well,
helps.
thank you.
No, thank you for sharing that, because I think this is one of those things I've always followed, because after going through the great financial crisis, somebody turned me on to this chart or these charts. And when you see these spikes, it's not because typically it's an emergency fund kind of situation, as we saw back in, if I put this on like a weekly chart, it makes it a little easier to see. But um, this is this is
That's
18, this is pandemic.
Yeah.
this
Kind of,
is,
it's a very, very good chart. I mean, I'll focus on this one from now on. It's a very, very useful tool.
yeah. So
Ger-
this is the
Gerard?
total,
Don't be hesitant to come back and speak up, because this is what our community needs, is putting our heads together to understand.
And Trent, you've brought this up on our morning meeting too. We've been talking about it for a while.
Okay.
We have another group that we talk with, Trent and I do, and we talk about this a lot. And they're people from the industry or retired from the industry, and this is really what they're concerned about.
Okay.
yeah. So I bring this up because it's part of that process that you're building. And this is one of those pieces of your risk management pie. When liquidity gets scarce, and I've talked about this for a while, when stocks get this high, or you see these vertical moves, or like what we've seen in gold. Let me find gold here. These spikes in gold that we've seen for a while now. This move from August, just say August 27th, end of August to the peak in gold. To me, I look at that and I go, okay, that people are taking their profits out of this. You're having a spike in gold all of a sudden. And so part of your process has to include, you need to include risk management. And these little things like gold prices moving so high, or repo markets, what are they telling us? And I think that's the fun part of this, is what is this telling us? And going on to ChatGPT or Grok and saying, what does this mean? How can I become better by knowing this?
Well, can you
Not to
do
be a
that and let us
buzzkill,
know
but
by Monday morning?
hopefully. But I just want to address one other thing. I don't
Okay.
think there's an AI bubble. I think there's a credit market bubble, and
Okay.
that's bigger.
And I think
And
I agree with
this,
Trent, but I think there's also a price bubble on valuations of these stocks.
yeah. So think about it
Okay.
over the weekend.
Thanks, Dr. Doom. You got to change it for Mr. Bubbles.
Oh, come on.
So how does the credit bubble affect the AI non-bubble?
Well, here's
I'm
what
trying to find the connection.
here's what I'm going to tell you. When Jeffries files bankruptcy, and they will probably next year sometime, when
Maybe.
they file bankruptcy, it's similar to when Bear Stearns had to be bailed out by JP Morgan in 2007.
And why do you feel it's Jeffries?
Because they
Yes.
are dealing heavily in the subprime world.
They're in that tricolor subprime auto deal.
And the thing about this is, it's a contagion. It starts with subprime, the lowest level of credit, and it creeps up. Think of it as the earth, and subprime is the core. And when that fails, it creeps up to the surface. AAA debt. So US treasuries are AA, but AAA bonds, AAA credit, that kind of thing. That's the best credit you can get. When you have no credit, no rating, or you have triple or single C, triple C, single B, double B, triple B, you start to see it, the contagion move up. And that's what our fear is, or my fear is that you're going to see this contagion of subprime credit failing, which we're already seeing happening, and it's going to start snowballing. And you're going to see job reports, more layoffs, 30,000 jobs from Amazon, 1,800 from GM. They're laying these people off. Target, 1,700, six-figure income people getting laid off. They can't pay their bills. That feeds into the system. Amazon can nail it every quarter from here till eternity. But if the credit system breaks, It doesn't matter. And that's what happens. Like good companies broke down during the great financial crisis. Good companies broke down during the dot-com. It was because of credit. It was because of liquidity. And what we're seeing is signs of this. And so how do you manage this? You keep an eye on it. You become aware of it. When stocks get frothy, like gold, that spike, when you see that charts, you see that spike like that, take notice and risk manage around it.
My concern would be, Trent, is if they took those subprime loans, which are, trash loans, junk loans, and they started mixing them into a product like they did in the great housing crisis and put them in tranches, with triple A's, A's, B's, and sold them off. And that, you remember that guy took out that little piece and the whole thing fell apart? That would be my big concern if they did that. I don't know that they did or not.
My friend, I had a coffee with a friend of mine. He works for a mutual fund company, a major one, this week, and we got to talking about collateralized loan obligations, CLOs. And he says, "Yeah, my company and two others have sold $45 billion worth of this product to retail investors through their financial planning networks." He goes, "This is dog shit." That's how he put it. He goes, "This is dog shit. The same thing they're doing." And I was like, "Well, why don't you be honest and be, about this?" He's like, this is, we have to pay attention. And we're getting to that point. And I will say this, S&P 7,000, it'll happen this year. It's when we get into next year, when books, when things start to accelerate, that's when I'm going to be very nervous at that point. And what I see spikes like this, that puts off alarms in my head. I'm like, that's amazing. That's $44 billion more that was borrowed overnight or swapped out overnight versus last night. That's a lot. It's a lot. Just weird. But just be a better investor, be aware, question everything, be X-Files Mulder and question everything. So,
Steve,
what you got, Steve?
you get the final question.
You're on mute, Steve.
Unmute.
Still on mute.
You're still you're muted,
Steve,
Steve.
you're muted. You gotta unmute yourself. Still muted.
There you go.
Okay, thanks for everything, guys. I really appreciate it. But I saw in the news today, UPS is laying off 48,000.
Yep.
Of course, the Amazon is 30,000. Ford is laying off 11,000. They had a whole list of them.
Yep.
And it's pretty scary.
It is. And we've been watching the jobs reports, Trent and I, for a year and a half now, going, this can't be right. And then they came out and they revised that jobs report. Remember, 1 million jobs. Oops. Oh, those weren't there. And we're like, yeah, there you go. You dig into it a little bit, see how they do jobs reports. When we dug into it, it's like, well, if Trent had 3 jobs part-time and I had 4 jobs part-time, that counts as 7 jobs. Okay. That's not right, but that's how they they screw these reports up. And I said, well, I think the final leg is when people start losing their jobs, or your neighbor loses a job. They always say, when your neighbor loses a job, it's a recession. When you lose your job, it's a depression. And then people stop spending. And if you can't have a job, you're not going to have a car. You're not going to send your kids to college. You got to worry about your house payment. And that's okay if you have savings and investments, but a majority of people are living paycheck to paycheck, and they also are maxed out on their credit cards. People are going to grocery stores and buying with buy now, pay later for groceries, and that's what Trent and I watch all the time. So we get a little passionate about it, but that's because we care about you guys and we just want to bring the excitement down a little bit.
Well, I appreciate it because you got to know where to go. It's just, I keep an eye on things anyway.
Yeah. So one little last note, I put it on the Discord. I'm going to send an email out. If you follow the tell sheet 12, there's a stock in there called Affirm, AFRM. They're a pay now or buy now, pay later organization. It's something I've been questioning because of what what we've just been talking about, consumer credit, consumer ability to pay back debt. They just took a $750 million off the balance sheet loan from New York Life, which tells me, well, why? Why do you need that kind of money? Their debt to equity is, or debt to revenue, no, debt to equity, I believe it is 2.5%. So their debt is 2.5 times more their earnings. This is a company, I took it off the list as of today. So Monday, I'll put it something new, but this is what I'm looking for is consumer-based companies that are having, who could be susceptible to delinquencies and that kind of thing. So just want to make a note of that.
Look at what happened to Pfizer this week when they did their earnings, and look at Zeihan. Zeihan had issues too. So it's starting to percolate through some of these little regional banks. So just be aware of it.
Okay.
That doesn't mean we can't invest and trade. I mean, we trade all the time. I could put out a list every week and we can trade those things, but always have your stops in. When you get into a position, know where you're going to get out, even if it's an investment.